All right, well, I think we can get started. I'm Tiffany Dickinson. Welcome to the 43North Small Business School. I am the creative content producer for 43North. And today we have the guys from Lumsden McCormick here to talk about all the accounting best practices for small businesses. You know, expense report, balance sheets, all that good stuff. They've got a lot of great stuff for you, followed by a Q&A at the end. So if you've joined us before, you know how this works, but just please put any questions you might have in the Q&A feature. We will not be monitoring the chat feature. So if you do have questions, we'll get to those at the end. Okay, well, let's get started. I'm going to hand it over to you.
Cool. Thanks, Tiffany. This is Corey Van Duzen talking right now from Lumsden McCormick. I am a partner at Lumsden on the tax side of things and in charge of our commercial group. And I deal with a lot of different types of companies, startup companies, tech companies, manufacturing companies, run the gambit basically. And it's our understanding that today we have probably different types of people in the audience. Anywhere from a sole proprietor to a startup to a larger operation that may have been in business for quite a while. So we've tried to tailor this presentation to any and all that might be interested in watching it. And basically what we're going to do is we're going to go over some best practices on the accounting and finance side that we think will help you make better decisions and informed decisions by having timely and accurate information. That's really what helps you make some accurate and good business decisions. So I'm going to shut up in a few minutes after I make the introduction to the stars of the show, who are Doug Muth and Tim Bubar. Doug Muth is a principal in our audit department and works with a lot of startup and tech companies. He also works with a lot of other commercial businesses as well. And Tim Bubar is a principal at Lumsden McCormick, and he is one of the people that's in charge of our client accounting and advisory services. What does that mean? That means he could kind of be your controller or outsourced CFO. And Tim started his career at Lumsden and then took a 15-year-ish hiatus and was the CFO at businesses outside of public accounting. So he has actually been in the trenches, similar to a lot of the people on this call, and helped to run a family business. So he's got a lot of experience in terms of what works and what doesn't work in the real world and not just theoretical. So with that, I will try and be quiet now, but I like to talk, so I can't make any promises, and hand it over to Doug and Tim.
Thanks, Corey. So I'm going to get started and kind of go through just what the basic financial statements are, and then Tim's going to go through some best practices. And then certainly, we look forward to answering any questions you may have at the end of the presentation. So here are kind of the main objectives or the main topics that we're going to talk about. Just gaining a fundamental understanding of the financial statements, their purpose, the balance sheet, the income statement, statement of cash flows. And then where Tim takes over, we'll talk about some key performance indicators, budgeting, billing and collections, purchase orders, capital expenditures, cybersecurity, and just some ways to leverage technology. So, regardless of what stage your business is in, what type of business, it's important that you have financial statements. These are going to be important to your investors, to the bank, or any other stakeholders of the company. And even you as an owner, it's good to see this. And really, when I start going through the statements, you want to have all of these statements. Sometimes people just want to focus on the profit and loss statement, but you really have to look at all these statements in concert to get a full picture of how the company is doing financially. So what's the purpose of the financial statements? What do they really do? So they answer some basic questions. What is the company's current financial status? What was the company's operating results for the period? And how did the company obtain and use cash during the period? So those three questions there really tie into the three main financial statements we're going to talk about. The first, what is the company's current financial status? That's really the balance sheet. What was the company's operating results for the period? That's going to be your income statement or your profit and loss statement. And then finally, how did the company obtain and use cash during the period? That would be your statement of cash flows. And who uses the financial statements? As I mentioned before, really any stakeholder of the company. So, it could be bank, owner, investors, others, depending on the type of industry, there could be many that use the financial statements. So the balance sheet, what does the balance sheet tell us? What are the assets of the company? What are the company's existing obligations, future obligations? And then finally, what are the company's net assets? So, your assets less your liabilities would be your equity or your net assets. What the balance sheet really does, it presents a company's financial position. And just a couple other names that you may have seen it called: statement of financial condition, statement of financial position. And the balance sheet represents a point in time, so similar to a photograph. And that's a little bit different than the income statement and the cash flow statement, which those are both over a period of time. So a balance sheet you could look at any point in time. It doesn't have to be month end, year end, quarter end. You could just pick any day of the year and you could look at a balance sheet and say, at this point in time, what's the company's assets? What's their liabilities? What's their net asset position? So it really is a snapshot of the financial position of the company. So the basic accounting equation. Now, remembering back to introductory accounting, this is probably like the first thing that I learned. So your assets have to equal your liabilities plus stockholders' equity. So what are assets? So assets are really any item of economic value owned by the company. And typically what your assets are is that's how you make money. So it's things like inventory. So you have inventory and you make money by selling the inventory. So some examples: cash, investments, accounts receivable, inventory, property and equipment, prepaid expenses. So these are a lot of the traditional ones. I know with some startup companies, you'll see things like, capitalized software, different items like that. These are a lot of the traditional ones. So, your asset is really anything of value that's owned by the company. And these can be tangible or intangible as well. Your liabilities. So what's a liability? A liability is a debt or obligation that arises during the course of business. Someone else's owned. It could be, an employee, a bank, a vendor. So these are things like accounts payable, wages payable, interest payable, deferred revenues, or debt. So, think of it, anything that you owe to somebody else, that would be a liability of the company. And then finally, your equity. So your equity, as I mentioned with that general equation, that's the difference between your assets and your liabilities. So that could be things like, capital contributions by the owners. It could be your income each year. So as you generate income from the business, that accumulates in retained earnings, which is part of equity. Conversely, if you have any losses, that's going to reduce your equity. If you pay out any sort of dividends, that's also going to reduce your equity. So it's what would be left if a company sold all of its assets and paid all of its liabilities. One caveat here, though, is your balance sheet's on a book basis. It's not a market value. So, if you get into a situation where you're looking to sell the company or something, certainly the book value of the company isn't necessarily what you're going to get for it in the market. So just wanted to kind of throw that out there as well. So, a lot of things like your fixed assets, that they're all recorded at historical cost on the balance sheet. So the actual market value could be, much different than that. So this is really on a book basis, not a market basis. So the balance sheet in greater detail. So this is just a very simple balance sheet that I wanted to show to kind of show you, how a balance sheet looks, what type of items could be on it. So typically, balance sheet will be comparative. It's going to show 2 years and at the end of the year. So, and we list things on the balance sheet in the order of liquidity. So you have, your cash and cash equivalents, your investments, accounts receivable, inventories, prepaids. And those are what are called current assets. So current assets are anything that's expected to be satisfied within a year. And then you have longer term assets, things like, your fixed assets, your property and equipment, that type of stuff. So this is kind of what a standard balance sheet will look like on the asset side. And as I mentioned, your assets are presented in the order of liquidity. Current assets listed first, followed by non-current assets. Your current assets are consumed or converted into cash within 1 year, and your non-current assets have a life in excess of 1 year. And as I mentioned, an asset can be tangible or intangible. So your tangible assets are things such as cash, investments, inventory. Intangible assets can be stuff such as, goodwill, capitalized software, customer lists, that type of stuff. Next, I'll just kind of quickly show the liabilities and stockholders' equity side. So as you see, the point of the balance sheet is your total assets have to equal your total liabilities and stockholders' equity. So at the end of the day, that's the first thing you want to really look at on the balance sheet to make sure that those two numbers agree. So if you take a look here, you'll see things such as your notes payable, current maturities of long-term debt, accounts payable, accrued expenses, income tax payable. Then on the longer term items, you'll have long-term debt, net of your current portion, deferred income taxes, and then stockholders' equity. So this can be any type of equity, common stock, preferred stock, additional capital contributions, retained earnings, potentially treasury stock if the company buys back some of the outstanding stock of the company. And similar to the asset side, liabilities are presented in the order of their expected size. And liabilities can have both a current and a long-term component that will be separated in the financial statements. So the one that comes to mind the most frequently here is long-term debt. So if you have some sort of term loan, it will typically follow an amortization schedule. So the way it's presented on the balance sheet, the current portion, which will be the amount that's due within 1 year, would be presented as a current liability. And the long-term component would be the remainder after that, anything that's going to have to be paid back outside of the 1 year period. And finally, the equity section of the balance sheet. So equity is divided amongst ownership units, and it's derived from invested capital plus accumulated undistributed earnings. So, think of this as anything that you pay in as an owner. So that would be your contributed capital. When you have new rounds of financing, any additional investment in the company, that sort of thing. And then also the accumulated undistributed earnings. So every year, as you make money, you're going to have your net income. And if you pay out any sort of dividends or distributions, that's going to subtract from that. And that's going to really be what accumulates in equity. So next is the income statement. And what the income statement does, it summarizes the results of a company's operations over a period of time. So, most commonly this is going to be annually, but you can do it monthly. You can do it quarterly. You can really do it for any period that you want. So, if there's a reason you want to look at like a 2-week span, you can certainly look at it over that 2-week span. And this shows what goods were sold or services performed that provided revenue for the company and what costs the company incurred in their normal operations to generate these revenues. So typically the income statement is done on an accrual basis, which is different than a cash basis. So you really try to think of accounts receivable, accounts payable. Just because you haven't got the cash in the door, if you made a sale, you're able to recognize revenue. And just because you haven't paid a vendor yet, if you incurred those expenses, those are going to be showing up on the income statement. So at the end of the day, it shows what the earnings or the company's net profit is. Some other names for this, profit and loss statement, that's probably the one you hear the most common, profit and loss or P&L statement. Statement of operations. And as I mentioned, it shows profitability over a period of time, in contrast to the balance sheet, which is as of a point in time. So just looking at the income statement in greater detail. So this is just a very, very basic income statement. Depending on the nature of your business and what you have, it can get a lot more complex. You can show as much detail or as little detail as you want. For companies that have a lot of detail, oftentimes there are supplemental schedules that kind of show what the detail of cost of goods sold or your selling, general, and administrative expenses. So this is just a very, very basic income statement. So it'll show your sales, your cost of sales, gross profit, your selling, general, and administrative expenses, and then finally your income from operations. So, this part of the income statement, this is what you can think of as your core business activities. So if you're a manufacturer, this is going to be, your revenues generated from selling the product that you produce, the costs associated with it, and then, the selling, general, and administrative expenses. So that would be things like rent, depreciation, things that are kind of necessary to run the business and to operate the business. After that is your other income and expense. So think of things like dividend income, interest expense. These are things that are outside of the core purpose of the business. But certainly if you need to take out a loan to operate your business, you're going to have interest associated with that. So that's going to show up in this other category. And then finally, depending on the structure of your business, if you're a C corporation, you may pay corporate income taxes. For those of you that are partnerships, sole proprietors, S corporations, there may be no corporate income tax. So this may not be applicable to a lot of you, but if there is a corporate tax component, you would show your income taxes, and then finally your net income. This statement here, again, as I said, it's a pretty simplified income statement. So we present the retained earnings changes right on here, and that their change in retained earnings is simply the net income less the dividends paid. For companies that have a lot of equity transactions, we may also have a separate statement of equity, which could show, an additional round of financing during the period, stock options, that type of stuff. So again, it just depends on the sophistication and the level of activity that a specific company will have. And then finally, your statement of cash flows. So this reports the amount of cash collected and paid out by a company in operating, investing, and financing buckets for a period of time. So basically, how did the company receive cash and how did the company use its cash? And it's complementary to the income statement. It indicates the ability of a company to generate income in the future. So, as I mentioned, the income statement is typically presented on the accrual basis. But as Tim will talk about later, one of the most important things of running a successful business is actually collecting cash. So, you can show strong revenues, strong income, but if you can't collect any of the money, it really isn't doing you that much good at the end of the day. So this looks at what the cash position of the company is. So then just kind of how the statement of cash flows here. Sources and uses of cash during the period. So it's the same period of time as the income statement. So if you're doing it for the year ended for the income statement, you would do the same for the cash flow statement. So the first thing you're going to see on the cash flow statement is cash from operations. So that is, you're going to start with your net income. You're going to add or subtract any non-cash income or expenses. So this can be things like, depreciation, gain on sale of an asset, amortization expenses, things that really don't have a cash component. They're an item that's on the income statement, but there's no cash associated with it. And then finally, your changes in operating assets and liabilities. So change in accounts receivable, changes in inventory, that type of stuff. So your cash from operations, that what it really tells you is it's the amount of cash that you generate from the core business activity. So, again, think if you're a manufacturer, this is the cash from, the manufacturing operations of the company. And the operating cash is kind of an important thing to look at. Your cash can be positive, but if this number is negative, it could indicate, some problems with the company. And overall, you may be able to, have cash because you're getting investments from outsiders. But at some point in time, you want to turn this cash from operations into a positive number. Then the next two items, you're going to have cash from investing activities and cash from financing activities. And I'll talk about each of those in a little bit more detail later on. And finally, you're going to have your net increase or decrease in cash. And then you're going to show how cash changed from year over year or period over period. The classification. The operating activities, these are transactions and events that enter into the determination of net income. So like I mentioned before, these are really the core business activities of the company. Investing activities, these are transactions and events. Think of how do you invest in your business? So you might purchase investments, you might purchase fixed assets, other items like that that are not inventory items, so they're not held for resale generally. And then finally, financing activities. So this is, how did you get the resources to run your business? So let's say you go to the bank and you obtain a loan. That would be a financing activity. Let's say you have, some investors and you have a round of financing. So you issue preferred stock, that would be a financing activity. So those are kind of the breakout of the cash flow statements. And here again, just kind of a quick plain vanilla example of what a cash flow statement will look like. So first, the operating activities, you start with your net income. You show those type of non-cash expenses, depreciation, amortization, gains or losses, changes in your operating assets. And that gives you net cash provided by operating activities. Then next, you'll see your investing activities and then your financing activities. So as I mentioned, things like purchase of property and equipment is an investing activity, purchase of investments, the financing activities, proceeds from long-term debt, payments on long-term debts, any type of issuance of common stock, dividends, distributions paid out, that type of stuff will be on the financing side. Then finally, your net increase or decrease in cash for the year. And then you show your beginning and ending cash balance. All right, well, I will turn it over to Tim now, and Tim will walk through some best practices.
Thank you, Doug. If you remember at the beginning, Corey brought up a couple of items. You want to be able, as a small business owner, a startup, or even a large company, you need timely information to make good decisions. If you're not at least getting your balance sheet, profit and loss statement, and cash flow statement on a timely basis from your accounting department or your CPA, or if you're just getting it one time a year to see how you did, you really need to look at how you're running your business and how you're operating, because you really need this information to make good decisions. So some of the best practices that we came up with, what I did is, because I'm doing a lot more of the outsourced accounting type work, I looked at what are some of my small companies, but I think these are good areas to think about. Hopefully some of the things I bring up you're already doing. Hopefully it reinforces what you're doing. And if there's at least one thing you get out of this that says, you know what, I need to look at things a little differently, I think it'll be worth it for everybody. So our first best practice is key performance indicators. So what is you usually hear KPI. So KPIs assist in meeting company objectives and goals, such as, we want to achieve a profit of $1 million this year. Okay, how do we measure that? How do we get there? We want to produce 50,000 candy bars per shift. Okay, what is that? What do we have to produce per hour? What kind of equipment do we need to do that? How many people do we need to hire to do that? And maybe we want to reduce our product spoilage to 2% of sales or 2% of inventory. KPIs also can provide focus and goals for employees, and you'll kind of see this through my presentation. I bring up buy-in from employees. All successful businesses have their employees engaged. They know what they're doing, and they have that accountability, to kind of make things happen for you. You can't run your business on your own. you know, I'll raise my hand. I ran my family's business for a few years and I put a little too much on my shoulders. You got to be able to pass off the work and trust the folks you're working with. And then KPIs can also provide feedback on performance, either with employees, with equipment. How are we doing overall? Next slide, Doug. So hopefully you've seen some of these financial KPIs, your gross margin, sales less cost of sales. You know, Chuck Lumsden, who was the founder of Lumsden and McCormick, used to sit on our board at our family's business. And, you know, he told me, Tim, you're not going to make any money with a 17% gross margin. And I said, I know, Chuck. And I put my head down. But, you know, if your industry you're in says, well, you need to be at a 25% gross margin and you're only at 17%, you're probably not going to be in business much longer. So that's a good indicator of where you are. Inventory turnover. How many times does your inventory turn? I have one client, they have one big mailing they do a year. Their inventory turns once. That's fine for them. For another company, if they're not turning their inventory once a month, there's probably problems. There's a sales issue. Something's going on there. Days of sales and accounts receivable. If your current terms or your standard terms are 30 days and we do a calculation and your days in sales are 75 or 90, you have a collection problem going on. You may need to change the way you're doing things or look at why that's happening. Another one is your current ratio, current assets over current liabilities. And if you go back to Doug's presentation, you know, your cash receivables, you know, your liquid assets over your current liabilities, that tells you how you're doing. Your banks always look at that. It tells you, do I have enough cash and assets to pay my current liabilities? Next slide, Doug. And there's a lot more financial KPIs that are out there. These are just a few. Operational KPIs. These are more, okay, we're operating the business. How do we want to track things? Maybe you need revenue per hour or revenue per salesperson. Cost per hundredweight produced. I have a client that produces sugar or packages sugar. We generally know based on what they produced, if their cost is over a certain amount, there's going to be a loss. If it's below a certain amount, there's going to be a profit that month. And we kind of know early on how we're doing for the month. Is there a problem with equipment or something like that? So these are good indicators of how you're doing. In accounting, with what Corey and I do, we're a law firm, your chargeable hours versus your available hours. If you know, Corey's only charging, he's only 10% chargeable, I'm going to have a talk with him. Corey, you need to be more chargeable. Future booked appointments. So we just started working with a medical spa. And one of the performance indicators is how many appointments do we have? How far out are we? And what we can do with that is determine, you know what, do we need a little more radio advertising, or do we need to do a billboard? Or, you know, I can take those numbers and project out their revenue for the next month. So that's what these types of things can do. One other thing I like to look at is rolling 12-month averages. You know, we tend to get into, well, this is what happened this month. This is what happened at the end of the year, and we start over. You know, rolling 12-month averages will tell you a trend of what's going on in your business. And if you see a dip, all your other data. Next, Doug. So with KPIs, choose KPIs that have meaning to your company and industry. Not all KPIs are for everyone. Find the thing that, you know, as a business owner, you generally know in your gut what's going on. Find those KPIs that reinforce that, you know what, I know I'm doing good and these KPIs tell me that we're doing good. Or this KPI isn't where it needs to be. We need to make some changes or look into it. You know, and find industry comparisons and standards that kind of you can kind of measure yourself with how you're doing overall with others. I put this other thing in here, not really a key performance indicator, but it's something to think about. You know, your fixed costs of your company, whether you open the doors that day or not, or whether you make a sale or not, you have costs that you have to cover no matter what. So how I present it to clients is, what does it cost to open the doors every morning? And then even go down to, what does it cost to open the doors every hour of the day, whether I have a sale or not? That really kind of gets you focused on the dollars that you need to produce and the margins you need to produce just to even break even. So I think that's a good thing to look at. Next, Doug. Budgeting. I will raise my hand and I will say I was never a big budget person. And it's probably because I'm an accountant and I kind of can look at numbers real quick and I kind of know how you're doing, but not everyone is like that. I've been working with one of the larger companies. We used to do their audit. They were bought out and I'm still doing some outsourced work for them. And they do a lot of budgeting and variance analysis. And I found it's very important to know what's going on. And I think every company should do it. It's kind of, we're putting a stake in the ground and this is where we think we're going to be this year. This is our plan for the year. This is what we're projecting for the future. It may not have to be a 5-year plan or projection. It could just be, this is what we want to do this quarter. This is what we want to do this month. This is what we expect for the next 12 months. You know, a budget can be static or dynamic. Not a lot of dynamic budgets that I've seen out there. But like I said, a static one, at least we've determined this is where we want to be and now we can measure ourselves. And you can have a real simple budget. You can have a real complicated budget. I've seen budgets that have like 20 tabs in an Excel schedule, and it's real hard to find out where the data is coming from. Depending on your company, you know, it's up to you how detailed you want to get. Next, Doug. So there's different types of budgets. I'm not going to go too far with that because I got a lot to get through. You have incremental budgeting, activity-based budgeting, value-based budgeting, and zero-based budgeting. Next, Doug. You know, incremental, that's probably one of your most common. You kind of take, you know, last year's actual numbers, you add or subtract a percentage to get a current year budget. One thing to be aware of is the padding of the budget. You may have folks that are like, oh, we're going to put a little extra in so we look good to the bosses later. That's not the idea behind the budget. It's really to just measure where we expect to be and how are we doing. You know, sometimes, why does that division always look great? Well, maybe they've padded it a little bit and you got to look into that. Next, Doug. I don't see a lot of folks who do activity-based. Doug and I were talking about it yesterday. He doesn't have anyone really doing that, but it's kind of a top-down approach that relies on inputs to support targets set by the company. So we want 100 million in sales. You know, what activities need to be undertaken to get to that point? You kind of build your budget from there. Next. Value-based budget, another not real common. So what this type of budgeting does is it makes sure everything in the budget creates value for customers, employees, and other stakeholders. Next, Doug. Zero-based budgeting. Now this one, I've been doing a lot of work with the one company with it. And what it is, well, our year is over. We start from scratch again. We start at zero. It's considered more of a cost containment approach. It can be time consuming, but what I like about it, and I think this is important for a lot of businesses, forces you really to look under the hood and where you're spending your money and why. It's easy to have things get away from you when you're running a business. You're doing a lot of different things, especially a small business, but taking the time to look at where are we spending, why are we spending it, it can open your eyes to stuff. So budget shouldn't be a use it or lose it, or what I call the governmental approach to budgeting. you're using it as a tool to measure what we expected to happen, not, oh, I gotta spend my advertising budget because if I don't, my boss won't give us that number next year. That shouldn't be the attitude in your company, because maybe we just did the advertising to to get it done, but did it really provide value to the company? Did it provide an increase of sales for you? Remember, the budget's a tool to measure what we expect to happen. You're always going to have variances from your budget. This is your best guess. And what you do is you take the variances, and they may bring up action items in your company. Wow, repairs and maintenance are up 30% this month from last year. What happened? Well, we had to refurb 3 of the forklifts because they keep breaking down. So as the owner of the business, you may step back and go, you know what, maybe I need a couple new forklifts. And it could be a simple decision as that. Okay, we'll spend the money on the forklifts, but our repairs and maintenance will go way down. And that's happened with this bigger company that I'm working with now. And then what I brought up before, make your employees part of the process. Give them ownership in it. It's not use it or lose it. It's use it smartly. And, it's really asking, why did we spend the money? Was it needed? Did it help the company? Next. Billing and collections. This is a big thing for a lot of small businesses. Invoicing and getting paid by your customers is the lifeblood of your business. You could produce the best product, print the best looking poster, have the best of everything. If you don't invoice your clients timely and collect it, you're not going to be in business very long. So sometimes I call it, are you running the business, or is the business running you? So one of the things I like to ask clients is, how long does it take your company to send an invoice to a customer or a client? Is it one day after you ship? I think that's pretty good. Is it 1 week after you provide your service or you ship your product? Is it 1 month after you do it? Depending on the company, all of those can be applicable. I would say if you're a month or over, you really need to look at, why is it taking that long? Especially if you're a contract manufacturer, you've put a lot of payroll and materials into something, you get it out to the client, and then it's sitting on someone's desk, or it's in your accounting department because, well, we're waiting for more info or something. That's dollar bills sitting on your desk. That's what, my uncle used to tell me. How come, and this was back before a little, electronic invoicing is much more prevalent now, but why are all these pieces of paper on the salesperson's desk? Why is that invoice not out? That's dollar bills sitting on our desk instead of us collecting it. Next, Doug. So as far as billing and collections still, set up an internal system to invoice as quickly as you can. Find out where the customer wants their invoice to go. Do we mail it? Is it electronic? Do you have an email address? How's the client paying you? Is it credit card, ACH, paper check? Get all that set up front. Your salesperson should have all of that, things like that. Once you send an invoice, follow up with the client and acknowledge they received it. They're going to process it. There aren't any problems with what's going on. The worst thing that can happen is you're kind of waiting, and then you call, oh, there's an issue, or we didn't get it. We don't do our check run until for 2 more weeks, and you just added a lot more time to getting paid. Next up. Another thing I think is really important, review your accounts receivable aging on a regular basis, whether it's daily, weekly. I don't recommend monthly. I mean, it's good to get your final because, it always seems like all the sales go out at the end of the month. But if you're looking at it weekly, you can spot something that, as the owner of the company, why is that taking so long for that client to pay us? Is there a problem? Do we need to make that phone call to them to get paid? Another thing you really need to do, identify your slow payers And if they're what you would call a good client, but they're just chronically slow for whatever reason, try to devise specific steps to get the person in charge of paying you that you know that person. So you can, phone them, email them, text them, do a Zoom call. They know you're looking for it. Make regular collection calls. There's nothing wrong with asking to be paid for the service that you've provided or the, whatever you've shipped to someone. You shouldn't feel guilty about it. I know sometimes you're like, I don't want to bother them or something. You know what? You provided the service, you need to get paid. Hold your customers to the payment terms agreed to. If they're constantly going over, and you can go to the next one, Doug, they're constantly going over, or if they're constantly short paying, or you have that customer that's always looking for a credit, I want you to reassess the relationship you have with them. And I know that's tough to say, every client's important, every customer is important, but I think what you're going to find is those customers that are slow pay, take a while, and are always looking for a credit, they're probably the ones you're spending a lot more time on instead of taking care of what I would call your A clients. And I have a couple of comments down below, which I mentioned before. Why are those dollar bills still sitting on your desk? So make sure you get the invoicing out. The other thing is I've recommended to my clients, rank your customers, A, B, C, or D. And if you've ranked someone a D, really look at, they do pay slow. They are the most demanding. They make the most changes. They're always looking for a credit, no matter what we do. You may have to say, you know what, I'm either going to charge them more, or, maybe you don't want them part of maybe you won't sell to them anymore. You have to make that decision. But I think it's important because it really opens up your eyes to, how you value your customers. If you're spending time on the D's, at some point you're going to miss something with an A and they're not going to be happy with you. So next, Doug. And I know we're running out of time. Purchase orders. I feel purchase orders are real important, especially for small companies. It's easy to get lost in, I'm buying this, I'm buying that, I'm trying to make it happen. But it's good internal control when you have it. You can track what's coming up. It's hopefully approved by an authorized person in your company. You can avoid duplicating a call or ordering something twice. It assists with processing accounts payable when you match up, your receiving report with the invoice and the PO. A lot of your vendors may try and ask for extras that they didn't talk to you about. The PO kind of tells you, well, this is what we agreed to and this is what I'm going to pay. If you have a lot of identical products, it helps you match up order to order and really helps out your accounting department. Next, Doug. I've highlighted a couple other things. So if you have a good PO system, you should be able to run a report and see what do I have coming up? We haven't received it, but oh yeah, I have that $100,000 order out there that we're going to produce next month. I'm going to need the cash in the bank to pay that because when I get it, that vendor expects me to pay right away. It gives you an idea of what's coming. And then the second highlighted point, and I know I'm going through this kind of quick, it can accelerate your month-end close. Sometimes, so going back to the collections, you as a company may be great at sending out your invoices and getting it timely. Not all companies are like that. And if you have a PO, at least you can say, well, this should be my future liability, and I can book it in my payables system. I won't pay it, but at least it tells me what's coming up and I've matched my expenses with my revenues. Next, Doug. Capital expenditures. This can be a big area for some companies, other companies maybe not. These are assets you purchase to generate revenue and profit, maybe increase your product offerings or enhance efficiencies. Well, if I get this printing press, I can run 20,000 sheets an hour versus 15,000 an hour. So I can run X more jobs a day or per hour. I will caution you, sometimes buying the shiniest, newest technology, the sales guy comes in, this is the best year-end deal, you have to buy it. Does that really mean that's the best use of your company assets? The other comment I'll make, and I've seen this, I've done some due diligence looking at companies that maybe a client of mine is buying, and I see a lot of year-end purchases. Well, why did you buy that? Did you need it? Well, no, my accountant said I made too much money, so I had to buy something to get the tax deduction. That's not the sole reason to buy equipment, and Corey's laughing because the reason to do that, maybe you accelerate a purchase to get it in for year end to get a tax deduction, but that doesn't mean that's the reason to buy it. Next, Doug. So my simple questions to ask, if I'm going to buy this equipment, will it increase sales and gross margins? If it's not, you really need to step back and go, do I need it right now? Can I wait a year? Is one customer driving this purchase? So if I'm going to spend $1 million on equipment, what if the customer leaves in a year? It's probably going to take me 3-4 years to pay this back. And now I'm stuck with equipment that's obsolete already, and I have a big loan to pay. So maybe you need to get a contract with your customer. Maybe they need to be a partner with you on it. Maybe they'll help you finance the equipment. I did that in my old company. I had a big client. He's like, we need this. We'll loan you the money to do it. Can you use the equipment for other customers? If you can answer those questions, you're probably well on your way of making a good decision. And then maybe, well, we'll get it for year end to get the tax deduction to make Corey happy. Okay, next. One other thing to consider, maybe you're getting that new computer system or CRM software or something. Do you have someone in-house with the expertise to get the most out of it? I have seen companies buy equipment. I've seen them get software and their people don't use it. And then all of a sudden you're paying a monthly $3,000 maintenance fee on this fancy software, and they're just kind of using it kind of how you use the old software. Well, that's not helping you grow your business. So make sure you have some employee buy-in on these things. Ask other companies that have bought the software. It's important to get that feedback from like a third party. Next. Real quick on cybersecurity. I'm not a cybersecurity expert. The only reason I brought it up is if you're not invested in with your company, private data protection is required. It's expected by your customers. It's expected by the government. It's expected by your employees. A cyber attack can shut you down. I had a client walked in one morning and there was the skull and crossbones. Please send me $5,000 Bitcoins or, you're locked down. He was down for a week. It cost him a lot of money. And now he has the $1,500 a month he's paying for the protection, but now the chances of it happening again are low. So you really got to weigh, is it worth being totally shut down because these places can do this to you versus, paying a little more to do it. And not just large companies get attacked. Next, Doug. The last part I want to talk about, technology is changing every day. So a year ago, we probably would have had a more in-person, we would have rented an area and brought a lot of people in at a hotel or a meeting area. Now we're all meeting on Teams, a very efficient way to communicate, this is Zoom. At our firm, we use Teams, WebExes, all that stuff. So what you want to do is leverage technology in your business for manufacturers. Maybe you can add something that tracks downtime on equipment. Maybe you can measure operator productivity. Maybe this person's always behind everyone else. Maybe they need more training. You can point out preventative maintenance. And as an owner, maybe you can get some real-time data to know what's going on and you can spot a problem earlier and solve it. Like we've been talking about, timely information. Next up. On the accounting side, lots of stuff out there. Are you invoicing electronically? Are you paying electronically? Electronic payments to vendors is sometimes mandated by your vendors. Can your accounting system handle it? Do you have the internal controls in place to handle that. We can have a whole other session on internal control. I'm not going to get into that too much, but you need to think about this stuff. Next, Doug. Expense reimbursements. If you're still having your accounting clerk add up all the receipts from the Excel file and they're cutting a check, you're missing the boat. There's apps out there. You know, your salespeople can put it together. Even Corey can do it now. And, you know, it just makes it more efficient. So if you can save, let's say you have 10 salespeople and it was taking your accounting clerk or your accounting person 3 hours to do their expense reports, you probably have it down to 15 minutes now. Now that person can be making collection calls, looking and doing some cost analysis for you. There's tons of apps out there, Tally, Expensify, Concur, they're all over. Next. And last, your payroll is another one. Plenty of companies out there to use. I strongly suggest you eliminate your manual time cards. That can eliminate fraudulent hours paid, you know, someone punching someone else in or out or, you know, late, things like that. You gain efficiencies in processing. Again, your accounting person now has time to do more analysis for you as the owner. And I think that's it.
All right. I think there's a couple questions in the Q&A here.
Doug, I got him. So a couple of things to add to before we get to the questions. I thought Tim gave some good real life examples and common sense, logical ways to make good business decisions. One thing to add to cybersecurity, something that we've been seeing, and I don't know whether this is really cybersecurity related, but it's like kind of identity theft related, is a lot of unemployment claims for just random people. I've seen probably 20 clients get notices that they filed for unemployment. We've got from employees at Lumsden McCormick that they filed for unemployment and they're fraudulent. So be careful. You might have some sort of 99G from the government for unemployment benefits that you didn't get. So make sure if you do that, you talk to your tax preparer or something on how to handle that. Or if you get a notice from the IRS saying you didn't claim some unemployment compensation or something like that, that could be the answer. I haven't heard any good answers on how these claims are being filed or where they're getting the information from, but it's something we're seeing. And then on the receivables and invoicing side too, I think that was some great advice. And actually, they don't teach you that accounts receivable and collections and cash stuff on the practice side of public accounting in college. Now, all of a sudden, you get higher up in the ladder, and I'm speaking from real experiences, and I all of a sudden have to pay attention to receivables and things like that from clients, and it was kind of a shock to the system. So somebody that's an engineer or a computer person starting their own business and things like that, they weren't trained to do that stuff. So it's like it's out of box thinking that you got to pay attention to. Just a couple of comments that I wrote down while listening to the presentation. Tim's taking shots at me during the presentation, but maybe like. First question, in QuickBooks, when I look at my balance sheet, I can view it in a cash basis or accrual basis, and there are significant differences between the two. What would cause these differences?
I'll take that, Corey. The easiest part of that would be you're probably invoicing your customers, so you have accounts receivable on your books. So that's your accrual basis. When you switch it to cash basis, you don't see the accounts receivable. And then on the other side, you won't see accounts payable. Those are probably the two basic things you won't see. Whoever asked that, I'd be more than happy to talk to you. We have a team of 4 people that do a lot of this every day, and we could probably walk through it with you to show you the differences. One thing Doug and I had talked about, which I want to bring up, cash versus accrual. You may be a small business. Your tax preparer will probably tell you, oh, you're on a cash basis. That's fine. But if you're looking to sell your business in the future, You really need your books on an accrual basis, and you need to do it from day one. Number one, because it gives you better information. Number two, if you go through due diligence and your books are not on the accrual basis, you're going to be paying an outside firm or a consultant a lot of money to get it up to snuff. So your future investors will have comfort in investing in your company. So you really need to think about that stuff up front. And that's stuff we do help folks with. So just keep that in mind.
Yeah. And along with that, Tim, I think that's great advice. When you start your business and you're smaller, it may seem like you don't need to do that. But if you do it at the beginning and make that investment, it's a lot easier later on. And I deal with a lot of startup companies, and some startup companies choose to make an investment in talent in terms of the finance and accounting side a lot earlier than others. And usually it's less painful when they go to the bank or go for financing, or one of their investors all of a sudden says, we want audited statements. And you're like, oh, what? What's an audit? So yeah, I think that's great advice. Next question. This is a good question. I'm going to kind of paraphrase it. Basically, how do you manage your time? Do you spend it on your business, or do you spend it on your accounting and filing the various tax returns and things like that? Where's the balance? How much time do you spend? Do you spend it all on accounting and finance, or do you spend it on actually working in the business?
I can jump in a little bit on that. I think, everything's kind of a cost benefit, and Tim, you probably have some thoughts on this too, but I mean, your major focus should be on running the business. So that's where you look into things like, potentially outsourcing some functions, whether it's your bookkeeping function, your HR function, that type of stuff. Or do you want to invest in hiring somebody in-house to do that? So I think there's a lot of ways to look at it. At the end of the day, you want to do what's most efficient. As you grow and get larger, it may make sense to, have an accountant in-house. It may make sense to have an HR person in-house, but for a lot of companies that are starting up, you can outsource a lot of that and end up getting, good quality service and pay a fraction of the cost.
Tiffany, I got a quick question for you. Are we allowed to go past 11 o'clock to answer these questions, or are you going to kick us out?
No. You can stay on as long as you need.
All right, cool.
Within
Sounds
reason.
good. I didn't know whether there was a magic button that just all of a sudden we away or something.
No. I'll keep it recorded.
Cool. Sounds good. Next question. How do you prepare to transition a 10+ year accounting firm? They holster all our records, our confidence is declining, and want a positive transition from old to new. I've seen how intellectual property, website domain keys, and other things cause a problem when business climates change. So to me, I mean, I've been fired by a client before, and I've gotten clients and things like that. Just be honest, make the phone call, do it in person, let them know that you're changing and why. And to be honest with you, they probably know it's not working properly anyways in the back of their mind or in their heart. And then there's a professional courtesy between CPAs. As long as your bills are paid with the prior accountant, and you get a letter from your new accountant authorizing the prior accountant to pass along information, it should go pretty smoothly. Doug, Tim, from an audit side or anything like that, did I miss something there?
No, I think you hit the nail on the head, and a lot of it, you don't have to worry about yourself. We've done this a lot. Other firms have done this a lot, so we kind of know the questions to ask and what type of information to get from the prior accountants. So it should be pretty seamless. You shouldn't have to spend a lot of time or effort on it.
And again, I appreciate when somebody does it by phone or in person, not via email or letter. Getting to open a letter, seeing that kind of sucks. It's happened to me before. Not a good day. All right, next one is this is very informative, but not being a numbers guy and trying to navigate this myself, never having used an accountant given my business as a concert promoter, would you suggest an outside accounting firm? This is a great question. And what I would say is usually somebody that starts the business doesn't need the records. Whether it's a one-person shop or it's got 30 people, the person that actually started and built the business can walk around an office or a plant or something and just look around and tell you we're making money or we're not making money, and they just inherently know it. It's crazy. It's really cool to see. But if you're going to ever pass on or transition the business, then yeah, you need some records. My suggestion is interview a couple of accounting firms or something like that. Get an idea of what they might be able to provide to you, have them look at your records. I mean, generally speaking, if we get a prospect, I'll take a look at their tax returns or financial data and provide comments on here. Well, you're doing this great, or we think we can improve here or save you money here in terms of tax planning and stuff like that. So even if you don't choose to move forward, a lot of times you can get some pretty valuable information just by asking for some sort of quote or discussion on what services they might be able to provide. Tim, talk today.
Can I just add one comment? One thing that's really important is kind of knowing what your long-term plan is. You know, when we're meeting with a prospect, we always kind of know, you know, what's your long-term plan to kind of get a feel for what services you may need. You know, right now you might be small, but you know, if you're looking to IPO or you're looking to sell, you may want to consider getting to a point where you can do an audit. You know, maybe that's not what you're looking for, so it may be bookkeeping, but just kind of getting an idea of your long-term plans is important. So, you know, us or anybody else can kind of give you good advice as to what level of service you might want.
Great point. Yeah. One of my favorite questions to ask a prospect is, what's your 5-year goal? Or where do you want to go? You want to sell it for $1 billion, or you want to rule the world in this business? So, because if you want to sell or you want to keep it long-term, then we can steer you in 2 totally different directions. Awesome. Awesome point, Doug. Thank you. Next one, can you briefly discuss the difference between draw, distribution, and dividend, and which one pertains to an S Corp when taking out profits above and beyond wages? A draw, a distribution, and a dividend are basically all the same thing in S Corp land. They're synonymous. You can use either term and make sure it be correct. So there really is no difference for income tax purposes. Now, that being said, if the S Corp was something else for the first 10 years of its existence, such as a C Corporation, then there could be some sort of taxable dividend. But generally speaking, if you're an S Corp from day one and you're 10 years into the game or 1 year into the game, and you have net profits left over after all of your expenses, including the wages that you pay to the employee shareholder of the S Corporation, dividend, draw, distribution, it's all the same as long as you have skin in the game or kind of like a net equity. Then it would be a tax-free distribution or a tax-free draw or a tax-free dividend. So hope that helps. If not, contact us and we can answer further. And that goes for any of these questions. We're here to help. This is really cool what 43 North is doing to help out the community and businesses in the community. I think it's awesome. Let's see, next one. Thank you so much for the presentation. It was very helpful. Cool. Thank you for the comment. We appreciate it.
Yes, thank you guys so very much. And thank
Another
you
one's-
for all your help with 43 North all the time.
Nice. We got another one. A question. Can we send out slides and or a recording?
Yeah, it's recording now, and we're just going to upload it to the YouTube playlist that we have all the other recordings on. So stay tuned, and it should be up in the next couple days, if not sooner.
We can provide you the slide deck too if you have ability to send it out too. So
yeah, I can include the link in the description of the YouTube video as well. So it'll all be right there.
All right.
All right. Thank you guys again.
Okay.
Have a good one.
Thanks.